Good morning and welcome to this second episode of our real estate talks. Today I am joined by Peter Papadakos, who is the head of European research at Green Street Advisors. As you know, our open-ended funds invest in both public and private markets. As a matter of fact, we invest in REITs, in open-ended funds and direct investments. And to have access to experts like Peter really help us to have a comprehensive view of what is happening in the real estate market. So hi, Peter, how are you today?
Doing well. Thank you for the invitation. Looking forward to our discussion.
My pleasure. So, Peter, you have recently published your pan-European commercial property outlook, and I have a copy here. Let's start with the last 12 months. What has been the performance of the various European commercial real estate sectors? And also, what can we expect for the remainder of 2021 and beyond, I would say at a macro level, and also in respect of specific key sectors?
Yeah, of course. Happy to take those questions. And just to say as well that, we have a research team is 12 people, so we have sector specialists, and, we're in independent research house so far as we don't do buys and sells of underlying real estate, so our clients are our subscription clients. So we have strong views both on the positive and on the negative side. Look at some of the slides for the slide deck, because I think that will allow to frame things. So this one is good insofar as it summarizes what has happened and what we expect to happen. So just to go through some of the numbers that you see here on the bottom, or I should maybe start on the top right hand side, where you see property pricing. So this is sort of a property pricing across Europe. 25 key markets that we cover across Europe for the main four property groups, and no surprise, of course, that industrial has strongly outperformed. I think it's outperformed beyond even the dreams of the bulls of industrial property. But I think what has ultimately happened is, I think you have a situation where cap rates, so yields, valuation yields, are even lower today than they were pre-COVID for sectors where the income has proven resilient. And cap rates are higher or flat at best for sectors where you still have some uncertainty of income. So, retail is a good example where yields are high and values are down, although as we approach now April and May, we are at a period of time where the 12-month trailing is no longer as bad as it was if you looked at the trailing back in January. I think also one of the key takeaways for the last 12 months is that this discrepancy in performance across sectors has been much wider than the performance across locations. So, if you invested in office in Stockholm or office in Madrid, the difference in performance wouldn't have been as wide as you had invested in, retail versus industrial across Europe. So it's really the sector that has been the key driver of performance rather than the location. The final thing just to say in terms of the last 12 months is, everyone has focused on rent collection. So how much of the rent have you actually received? The numbers are about between 25 and 50% for retail, 75 to 99% really for office. Residential and industrial have been above 95%. So that in terms of cash collection rates, big differences, and I think that's been a big focus for investors. As we look to the next 12 months and beyond, there's two things. I'll touch on the macroeconomic outlook, but for real estate, if you focus on the bottom left-hand side of this slide, you will see that in terms of our forecasts for market RevPAM growth, which is sort of it's a combination of market rent growth and occupancy rate growth in the different submarkets. We haven't really been changing our forecast in the last 3 months, so we still have, inflationary plus growth for industrial, and for residential as well. And then for office and retail, we don't think that we will be in a situation where our 2025 market rent will be in line with the 2019 or 2020. We still think we're going to be a little bit below because those sectors have some more structural issues. But overall, if you look at the bottom right-hand side, where we compare where values are for real estate versus bonds, as well as versus REITs. So versus fixed income alternatives, and these are both investment grade and non-investment grade bonds, we think real estate is undervalued. We think it could rise another sort of 10% plus in the next 12 months. Versus REITs, it's more challenged. The valuations are more challenged. In other words, the REIT market is trading at a discount to underlying asset value. And the REIT market has historically been a very good predictor of where direct property values go. So I think the overall signal, if you will, both from the fixed income world and from the listed real estate world, is that for commercial real estate values should go up somewhere between 5% to 10% if you blend all these signals. So a pretty upbeat view for the next 12 to 24 months for real estate.
Understood. And so since you cover both private and public markets, what can you tell us about the valuation of the REITs themselves and relative to the physical markets?
Yeah, of course. So just to put a little bit of context, if we just go to the next slide as well, in terms of, so that's the macro backdrop. I think the only thing I would say, and your viewers can study this slide in more detail after the presentation, but essentially you have a pretty good backdrop for demand insofar as job growth is positive, GDP growth is positive, and if anything, as the weeks and months go by, forecasters are revising upwards their projections for economic growth. So the landscape in Europe is reasonably good. I would say it's obviously not as strong as the US because of the fiscal response and everything that we know about how governments are responding to the situation. But I think in general, we have a good macro backdrop. The next slide as well, if we go to just to supply, just to put that context, and I'll come to REITs, of course, but it's important to understand the context. The supply, and this is supply as a percentage of stock and how much the supply is increasing every year. If you look at the red bars, you have industrial, which is very strong supply growth, right? And if you think about, okay, well, that should be concerning. In fact, it shouldn't be, because industrial demand for space is running at about 10% of stock. So if you think about it, these numbers showing around 7-8% supply growth, demand is 10%. So in actual fact, we have a demand excess of supply of 2 to 3%. Industrial REITs, just to tie back to REITs as well, are in a situation where they're sort of trading on par with NAVs. So the public market and the private market, are in equilibrium, let's say. But the private market, which we're talking about here, is actually going very strong, and that's why we see continued rent growth, because demand growth is above supply. The green shade, which is residential, if you will, permits or residential, forecast supply, which is running at around, a million or so starts per annum for the whole of Europe. If you think where household formation is, right, so demand for residential, that's also running just below that that line. So there's slightly more supply than demand perhaps over the next 5 years, but we're coming through a situation where we've had lots of demand versus supply. So there's been this shortage of housing for rental residential housing, which means that we're only trying to claw back some of that shortage of housing. So what that means is that for residential rents, we are seeing sort of that we might have more sort of inflation-like rent growth as opposed to inflation plus, which is the industrial. Interestingly, REITs are trading at discounts to asset values. They're trading at about a 10% discount to asset value on our numbers. So the public market, the listed market, is a little bit more cautious, I guess, in terms of pricing versus the private. We can go into why that could be the case, but I think two reasons to us come to mind. One is that obviously, as you know, and a lot of your clients know, residential real estate, the yields are quite low. And they're quite low because it's a stable asset class. The income is very resilient. So it's sort of a safer part of the real estate world. And the public market, the listed market, sometimes gets a little bit cautious about paying implied cap rates, which are below 3%. It has a very hard time paying for implied cap rates below 3%. So the public market is just a little bit behind. But I think the other interesting aspect is capex. So we all know what's going on with regards to regulations about greening portfolios, reducing the energy consumption, especially around CO2. And that is something that I think the public market in Europe has started to price in somewhat, insofar as residential landlords tend to have higher CO2 footprints. And we are seeing more and more taxation around CO2. And so that could be a sort of the public market is ahead of the private market with regards to future regulation. And then finally, I guess office. We had, as you see, that's the blue bars. The supply has been quite low over the last decade. We had a little bit of a spike in the last few years, but we think that's also transitory and it's going to come back down. Again, because developers are going to be more cautious with regards to developing new office stock, and obviously an increase in the adoption of remote working will probably mean that there's just no need to develop as much offices as we used to. And most of what is developed is to replace older stock, which is becoming obsolete. So what's interesting is the public market is disagreeing most with the private market. So we have discounts for office REITs, which are easily, 10-15% of asset value discount in the public market. So whilst we see strong still pricing and very, very high prices for long-let office assets in Europe, the public market is more worried about either remote working or either about, also capex and obsolescence of real estate. So I think that's sort of the sector where we have the biggest divergence between public and private.
What are your top geographical and sectoral peaks?
First of all, we do underlying demand supply analysis for every market, right? So 25 markets, 4 sectors, 100 sub-markets, if you will. And big picture, we see that, as you see from this sort of rental clock, if you will, which is if you are in between 12 noon and 3 p.m., you are in a declining market in terms of fundamentals are weak. And then you have recovery from 3 to 6 at the very early stages, or like a bottoming out. and then from 6 to 9, we see good evidence that a bounce back is occurring, and then 9 to 12 is where things have been running pretty well and probably slowing down a little bit. So I guess what you see in this is that just over half of markets probably are in, or locations are in places where in sectors or markets that we see good fundamentals, and then half of them are in sectors or locations where the fundamentals are weak. So, no surprise, of course, that you see obviously a lot of retail still being in the declining phase. So we don't think that rents have bottomed out. So again, it's a little bit of what we said before. It's not necessarily the locations that are as important as the sectors. And we see very high correlations within the sector across different markets. If you think about it as well, many of the tenants of retail are different, but some are the same. You have lots of international retailers who are located in many of these jurisdictions. So I'd say retail, we're still probably 12 to 18 months away from rents troughing. So we don't see good opportunities as of yet in a wide array of locations in retail. I think insofar as going in early in sectors where we think the fundamentals are not only strong or improving, but also the cap rates are still quite high. So you could make outsized returns. We would highlight definitely, UK and Ireland residential, and also I would say, other continental industrial we really like, and we'll go over some specific cities. And I would say in terms of the sectors which are between 9 and 12 p.m., some of them we're probably seeing some slowdown in rent growth. So from sort of something like 3% to more like 2%. So that's German residential, for example. Or there are sectors where for us to see a continued increase in rents above inflation, we have to continue to see a supply shortage on the housing. As I mentioned before, we think that looking at supply and demand, we think that the balance is quite even. In terms of just to explain a little bit the left chart. So the left chart shows the x-axis is what we think are unlevered IRRs, right, for different real estate sectors, and the coloring is it puts a label on one of 25 markets that we cover across Europe, right? So what you see is sort of the distribution of our returns by sector for 25 cities that we cover in Europe. So what you essentially see is if you look at the orange and the blue, which is retail and office, they're more to the left of that distribution. In other words, the returns that we see from those two sectors are typically between, I would say, 3.5% to 5% unlevered IRR. So obviously on a
over what time frame this IRR is projected?
This is typically like a 7-year period. 7 years. So yeah, so it's a 7-year IRR, and it's also incorporating. This is unlevered, so it's not a cash on cash. If you use leverage, obviously you could boost it, but because you have to make assumptions on leverage, we like to show things before leverage, sort of on an unlevered basis. If you look at the red and the green, which is residential industrial, you see there's a lot more markets where the unlevered IRRs are actually even into the 6s and beyond. So in general, we like industrial and residential more at today's private market pricing than retail and office. And then the right-hand side of the chart just shows you when we do those unlevered IRRs, we compare them to local 10-year government bonds. Because of course, if you are in Switzerland and the 10-year bond is negative versus if you are in Norway and the 10-year bond, is 1% positive, you can't compare those returns unless you scale them to local risk-free rates. So this is what this chart does. And I guess in terms of markets, we really like today, with regards to industrial, Copenhagen, Dublin, and Barcelona, still reasonably high cap rates within Europe, good rent growth, good long-term rent growth, and highest spreads to 10-year. The second cohort is for residential, so private rented residential, Amsterdam, Stockholm, and Manchester. For different reasons, I would say it's a combination of either good household formation, so strong demand fundamentals, or like in the case of Stockholm, not much in terms of supply. So one or the other, but those combinations strike us as good markets to invest on the private side. For retail, dominated by Germany, I guess, in terms of where we see Munich, Berlin, and then Dublin. But I think there is a combination of rents perhaps didn't grow as strongly in the from 2010 to 2019 as they did in either in some of the UK markets or continental European markets. So they don't have as much to fall back. I guess that's sort of more than compensated by the high initial yields. And then on the office side, Dublin, Gothenburg, and Berlin. That is again a combination of the starting vacancy rates in those office markets are quite low, well below 5% in many instances, or the supply as a percentage of stock in those markets are not as concerning given the projected job growth, office-based job growth. And one final thing also to say on the remote working concept, we're much more worried about it for London than for many other continental European cities, for various reasons that we probably don't have time to go through today, but including even cultural reasons, technological infrastructure reasons, commuting distance reasons. We think that London is quite sort of uniquely exposed potentially to more remote working than many other office markets in Europe. So we don't have much of a negative hit to fundamentals for many continental European office markets because of high remote working. We think it's going to be quite muted. So those would be our top picks within Europe and across sectors.
Now, there is one sector that I wanted to get your views. It's not specific for Europe, but I heard you and your colleagues talking about into different webinars, which is manufactured homes. Okay, there is an issue of affordability in the residential sector, and it looks like this type of product, residential product, really can address this. Can you tell us a little bit more about your views on these sectors?
Of course. So for those of you that may not have know what manufactured homes are, just to explain it, that think of it like a piece of land on which you have sort of mobile homes, and those mobile homes are all connected to infrastructure, so they're permanently based on pieces of land, and you as a landlord effectively owns the land under those homes. Those homes are either they can be bought or they can be rented, of course, to the people who live in them. But of course, because they are either outside of big cities, they are quite affordable. So also consider that a lot of them are really nice. So they have lots of amenities. They're usually in nice locations also from a climatological point of view. So people that are empty nesters want to go to a smaller home or within a community. Those are really good options, and there's some really high-end even manufactured home parks. So as a landlord, if you think about it, you essentially mostly own land. So there's very little in terms of obsolescence risk from your point of view. As you said as well, the demand for affordable housing is very strong. You've seen it in the US also during 2020. You had very little insofar as rent arrears or rent declines from a cash flow perspective for the affordable end of the residential spectrum. Where you had more issues was at the higher end and in big urban cities like New York and San Francisco. So manufactured housing is a sector which really started in the REIT space in the early 90s. It has had tremendously strong total returns. So there are REITs which have generated in excess of 15% per annum since 1993. If you think about that, that's an incredible amount of wealth creation. And even as we sit today, you would think, well, surely that sector must be, priced to perfection because it's done so well. But we don't think so. We think actually even today, in terms of the kinds of unlevered IRRs you can generate from that sector, is still sort of between 7 and 8%. And 7 and 8%, if you think that the 10-year US Treasury is 175 or whatever it is, that still is sort of about 600 basis points. So compared to markets that we show here in Europe, 600 basis points is generally on the higher end of what we find. And I think it's that combination of supply is rather limited. Also, if you think about manufactured homes, any community that has established housing, they probably don't want new manufactured home parks close to them because they are considered erroneously that they are sort of lower end and they may hurt values near their own housing. So supply is very difficult. Demand is strong. Also it plays into the demographics, right? As you have older populations wanting to trade down, the baby boomers wanting to capitalize on the value of their real estate and move into a manufactured home community. So you have good demand, limited supply, low capex, high yield, inflationary rent growth as well. And as a result, really good returns, and it's one of our favorite sectors. I would say it's up there with some other niche sectors, but it's probably our favorite residential sector in the US today.
It's very interesting. In fact, there are some REITs which are specialized in this sector, and their performance is public. But unlike Europe, it seems to be a very well-developed market, even on the private side. I mean, the brokers are quite active in selling this parks. Again, I attended recently this webinar where you were talking about deurbanization and suburbanization. Okay, so you presented this detailed set of data and really a framework to monitor the trends over the months and years to come as we return to normality. Now, that was a very, obviously, it's a dedicated webinar on the subject, but can you give us a summary of your conclusions, highlighting the nuances between the USA and Europe?
Yeah, sure. So when we talk about suburbanization or urbanization, just to be clear, what are we talking about? What do we mean? So urbanization is essentially the move on a net basis of people to cities, right? To big cities from smaller cities. Suburbanization is more sort of the people that are within a metropolis, they just move further out. They don't necessarily leave the big cities and go to smaller cities. So in that context, I guess there's two big conclusions from our end, and this sort of forms our view in terms of how we model all the forecasts on a city basis. One is urbanization we are strong believers in. So we didn't really ever our belief in that big cities are going to continue to grow bigger wasn't ever in doubt during the pandemic, even though we have seen population declines probably in places like London and New York and San Francisco. We always thought that was going to be transient. I think where we are, though, more open-minded is that we will see some suburbanization within cities. And it's important to make the following distinction. Whilst the city centers will not hollow out, and we don't believe that, we have seen, though, that rents in the city centers have declined, for residential, and quite a lot, actually. And then what has happened is that you had people who couldn't afford to live in the city centers, and they had to commute in, are now actually taking advantage of that. So you have a change, if you will, in the profile of residents in city centers that were able to afford higher rents. Those higher income earners have maybe moved out, and you have now moving in lower income earners who are taking advantage of lower rents. The point of this chart is, as we've looked at what drives rent growth, right? Ultimately, what drives rent growth, in our view, has less to do with population growth, although it is important, but more to do, relatively speaking, with income growth. In other words, if you are able to be exposed to cities where the average income per capita is growing fastest, that's when you can also push rent more. Population growth is important, but in many cities, even if you have more population, you actually have, over the medium term, not immediately, but over the medium term, you have more supply that meets that, higher population growth. So that doesn't help you over the medium term in terms of more rent growth, because supply meets demand. Real income growth is more important because you can actually push up rents and people can afford to. So I guess what I'm showing here is it's best to have both. And that's what we call sort of the fast ponies. Cities where we think there's going to be good population growth, but also good income growth. And what you see, of course, in Europe, the Nordics tend to have a disproportionate share of those cities. On the other hand, the slow ponies like Amsterdam, Frankfurt, Cologne, and Düsseldorf, they're good cities. We are seeing rent growth there. But the point is, and this is sort of this is a projection, I think by 2028, the point is that if you wanted to tilt your portfolio on a relative basis, on a city basis to certain parts of Europe, we would recommend that you have more Nordic exposure relative to maybe continental European exposure on a macro urbanization type context. And then the next slide, just so I can finish with that. In terms of how we've thought about it, and this has implications for all real estate investors, but we've sort of thought of it like a grid. So on the one hand, and this is sort of the y-axis, is how much urbanization, the rate of urbanization that we think will exist in future, versus pre-COVID. And as you see, the vast majority of the dots here, the vast majority of cities are, let's say, above the y equals 0 line, right? So in other words, we think that the majority of the cities will continue to urbanize. So more people will be moving into the cities from other parts of their countries or from other parts of the world. But I think the more interesting question is, where will those people end up living? Will they go to the city centers, or will they go in good, well-connected from a transportation suburbs around those city centers? And there we have different views. So places like Southern Europe, where either Barcelona or Madrid or smaller cities in general, we actually think that the majority of people will continue to move towards the city centers as opposed to stopping and living on the outskirts. Where the two cities, which are very important again in terms of how much real estate exists in there, which is Paris and London, we actually think there's going to be more suburbanization in those cities. It's very convenient, right, not to have to commute every day for an hour and 15 minutes to go to your office. The housing costs are extraordinarily high in the city centers of London and Paris versus very nice green suburbs with bigger housing. There's also, I guess, the acceptance from employers in terms of higher remote work adoption will play into it. So I think what this sort of chart tells you is, for cities that are to the right hand side, we necessarily invest, as we have for a very long time said, that CBDs will always do better than suburban locations. We're more open-minded that that's not going to be necessarily the case. I think it's one thing to think about, okay, what type of building you're going to invest in. Is it going to be A quality versus B quality? We can debate what's going to outperform there, but this is just purely from a location point of view. We would say that outside of Paris and London, most cities we still would say invest in the CBD, so in the central business districts of those cities. But for Paris and London, at today's pricing, we would be more agnostic insofar as we don't necessarily think that rents in the city center are going to outperform. In fact, they have been underperforming when it comes to residential quite a lot in the last 12 months. But even the pickup, we don't think is going to be very robust, and they're going to go back to 2019 for the next few years.
Thank you very much for your time, and we will be making available the slides to whoever wants. They can just reach out to us via email.
Great. Nice to be with you.
Thank you.
Thank you.